So what does this mean for decision making, right? So what are the implications for managers? Managers have to balance risk and tax benefits. Companies with high tax rates, stable sales, and low operating leverage desire debt. Remember that all firms have the same tax rate and that the tax code reduces the impact of taxation, but every firm has the same corporate tax rate. Now, Amazon waited till it had a consistent positive cash flow before significantly increasing debt. This strategy helped preserve flexibility and then later on reduced the weighted average cost of capital as that stability grew. So, rating agencies also frequently reward prudent leverage decisions. Managers want to avoid financial distress. They are very expensive. So companies desire to keep some excess borrowing capacity if they have uncertain sales, high operating leverage, or many investment opportunities. They need to have that ability to go out and get more debt should those things move against the company itself. So finally, if managers have asymmetric information regarding the company's future prospects, which we all believe they do, then they avoid issuing equity if those prospects are actually better than the market perceives. Again, they always want to consider the impact of capital structure choices on lenders, rating agencies' attitudes, and on the perception of shareholders. So, how can we find the optimal capital structure for a firm? We can use weighted average cost of capital and the capital asset pricing model, as well as the optimal capital structure that we've found, where the weighted average cost of capital is minimized. So let's see how we can find that optimal level of debt. So in this example, beta is 1, the risk-free rate is 6, and the risk premium on the market is 6%. This company has no debt. So W sub D equals 0. So what is the cost of equity? Again, if you remember, it's the risk-free rate, in this case 6%, plus beta times the risk premium. So 6 times 1 times 6 is 12%. So the cost of financing for this zero debt company is 12%. Tax rate's 25%. Let's assume the company has no short-term investments. They have no preferred stock, but they have 10 million in shares outstanding. Again, remember, this company has zero debt. So what is the value of operations for this company? Again, if we have expected free cash flows of 90 million, plugging into our valuation formula, we find out that this company has a value of $750 million. Divided by the 10 million in shares, roughly the company is worth $75 a share. Now we're going to have to go out and figure, we're thinking about borrowing money, so we need to know what the cost is going to be. So we go out to our creditors and we ask them, what are you going to charge us? So in this case, I say, look, if you borrow 20% of your capital structure, it's going to be 8%. 30% is 8.5%, 50% as much as 12%. Now, one of the things we're going to assume here is all we're doing is changing the capital structure. So whatever money we borrow will not be used to purchase any investments. It will only be used to purchase stock and replace that with debt. So we're really honing in on this financing question. as companies change its debt structure, obviously its risk changes. The risk of equity changes. So we have a formula, it's called Hamada's formula. And this formula basically allows us to adjust the beta that you and I see that's published based on the amount of debt we have. So beta sub u here is the beta of this company if it had zero debt. In this case, we had a beta of 1. That was the beta of this company, and it has zero debt. What happens if we change the capital structure? We're changing the weights out here at the end of this formula. So it's going to allow us to make adjustments. This can be used a lot for projects. It can be used for trying to determine the value and the returns in divisions or different subsidiaries of companies. So it's a pretty handy formula that allows us to adjust and work into our security market line formula theories. So let's use Hamada's equation. Plugging in our data, here's beta sub u is 1. We know the tax rate's 25%. And now we're going to look at what happens if the weight of debt changes from 0 to 20%, which means equity is going to go from 100 to 80%. The new beta should be 1.188. Plug that into the capital asset pricing model. The new cost of financing is 13.13%. Again, now that we know the cost of equity, we can now also plug this into our weighted average cost of capital formula. So now 20% debt times 1 minus the tax rate times the cost of debt of 8%. Add that to the 80% percentage of equity times its new beta, our cost, of 13.13. In this case, the weighted average cost of capital for this company is 11.7%. So what we'll need to do now is repeat this for all of the possible capital structures, right? We had 0, we looked at 20. We also have cost structures for 30, 40, 50, etc. So we need to submit and calculate all those differences. What we find is that going across the board at 0%, we know that the weighted average cost of capital is 12. If we use 20%, we know that weighted average cost of capital goes down to 11.7. At 30%, it's 11.6. Now, if we go to 40%, it starts to increase again. So we have a minimum amount of debt at a minimum weighted average cost of capital at a debt of 30%. That is our optimal capital structure. If we plug this into our valuation formulas, then we also will find that the value of operations is maximized at 30%. Now, stock changes and debt changes us because we're looking at different capital structure, but the value of the company is maximized where the weighted average cost of capital is minimized. We do this, we need to know how many shares we're going to buy back, of course. So the new shares minus the old shares, that's the 231.51 is the new debt. So that's the change in debt, if you will. Again, remember the old debt was 0. So if we had 10 million shares, and now we're going to get rid of 231.51 million in equity, convert that into the stock price, that means we're going to buy back 3.09 million shares. Again, the key points in general are this. Our short-term investments are going to change because we're going to borrow money, which means that's going to increase short-term investments on the short hand. But then we're going to use those short-term investments to buy back the stock. So the value of equity is going to fall because we are moving from zero debt to 20% debt. So equity itself has to fall. But in the end, the value of the shareholder is going to be at 771 million because shareholders now directly own all the funds that were held by the firm, including those short-term investments. Just an overall structure to see how this all fits together. Again, we see that once we go through the process and calculate each price of stock, we find again the maximum stock price is where 30% debt is found. Now, this is pretty complicated, and obviously there's a lot of calculations here, but there are some shortcuts. What is S? S is 1 minus the equity, or the weight of debt, multiplied by the value of operations. So a value of operations is 769 million. So that means stock is going to be 615.38 million. At weight equal, again, 20%. The shares post, you take the prior 10, you multiply that by, again, we have the 769 minus the 153,000 that we're going to pay out. Divide that by the difference between the value of the old and the debt of the old. So that means the new post price or post shares is going to be 8. So 769.3 minus the 0% for the debt or old divided by 10. At 20%, the stock price is going to be 76.92. Again, it's a little bit shorter. And unfortunately, you kind of miss all the relationships that are built at these different levels to kind of understand and get the nature of minimizing the cost. So what happens? The optimal capital structure minimizes the weighted average cost of capital, maximizes firm values. Different companies find different ranges. Johnson & Johnson stays low on debt. Apple balances debt with buybacks. And Amazon gradually increased leverage as its stability improved. So managers must evaluate their business risk, their industry, the growth plans to try to determine, again, what's best. And unfortunately, I think throughout these videos, we've talked about techniques that always give us an answer. They give us a solution. There's no solution here. In the end, management makes choices on how much they want to borrow. In addition, when you think about distribution to shareholders, there's no real theory that tells you what to do. So we have to use our intuition, our business sense, our understanding of the relationships between taxes, shareholders, creditors, rating agencies, regulators. We have to put all of that together to choose what we think is best for the company. Thanks a lot. Look forward to seeing you next time. Bye-bye.